Hi, I'm Edmond.
Hi, I'm David.
And we are from Financial
Financial
Alliance, Singapore's largest independent financial advisory firm.
Yeah, so today we're going to explore the web most searched question, which is how to make your first million.
Yes.
So Edmund, when people are thinking of making their first million, an investment portfolio comes to our mind. So the next question is, how does one build an investment portfolio from scratch?
Investing is one of the most reliable ways to build wealth. So if you're starting an investment portfolio from scratch, you should first understand your investment objectives and also your time horizon. Next, you need to understand your risk appetite and then to build a portfolio that is in line with this risk appetite.
A simple way will be to purchase mutual funds and ETF to have a diversified portfolio.
Yes, definitely. With these sensible steps in place, all that is left to do is to just let time and compounding effect do its thing. Of course, you need to review your portfolio periodically to ensure that it still meets your current investment objectives and also your risk appetite at that point of time.
And if you want to get to your goal of $1 million sooner, probably we could add our pay raise, our bonuses, and our frugal spending, put that money into the portfolio so that we can reach our goal faster.
Our next question is, how long does it take to make your first million?
Reaching your first million will also depend on how much you could invest and what are the returns you are getting from the market. So for example, if you earn an income of $5,000 at a savings rate of 25%, then you invest with a return of 5%, you can actually reach your goal in 30 years.
Wow, 30 years? That seems like a long time. While investment returns can be volatile, what we can actually control is our discretionary spending, which can directly affect our savings rate. So instead of saving just 25%, if you're able to save 50% and invest that instead, you actually reach your goal of $1 million in 20 years instead of 30 years. So that is actually 10 years faster at reaching your goal of $1 million.
That's true, Edmund. I think on the defensive side, right, we can actually control our spending and we don't let lifestyle inflation creep in. At the same time, offensive move can be increasing your income, pursuing side hustles, or you can pursue both at the same time, defensively or offensively.
David, that's a good take on this, to use both defensive and offensive strategies to build our wealth. Okay, one of the ways to find out for yourself how to reach $1 million is to actually use free calculator apps on your phone. Or another way is to pester your financial consultant to help you to calculate how long does it take for you to reach $1 million. Okay, David, we have discussed sensible ways of growing wealth reliably. But one question that people have is, what is the quickest way to become a millionaire?
That's a good question. I think the quickest way to become a millionaire is to probably be engaged in trading, cryptocurrency, lottery, or gambling, which has a very high probability of loss, which might force us further back from our goals.
Okay, yes, David, that is true. Okay, for me, I think that one of the quickest way to build wealth is to actually build a business that solves a big problem. The bigger the problem you solve, the more the money you make. But take note that for every one successful business, there are 5 to 10 businesses that actually fail. So the failure rate is extremely high for businesses. So definitely a high risk, high return investment. So a more reliable way to build wealth is to actually just using the previous method to invest at least 25 to 50% of your income every single month in a globally diversified portfolio, and eventually you'll reach $1 million. Alright, David, the next question is, what are some of the things that can sidetrack us from making our first $1 million?
I think one of the books that I read recently is not to let your expectation rise faster than your income. This book is by Morgan Housel, writing the book Psychology of Money. Your financial success will be hindered by many reasons, and one of the reasons is lifestyle inflation, lack of expenses tracking, mindless spending, and probably ultimately, I think it's important to have a plan.
Yes, I agree, David. I would say one of the things that can sidetrack us from getting our first million is definitely our lifestyle. So a lot of us, we tend to enhance our lifestyle in line with our income. So I'm sure you have heard of the phrase, spend within your means. That's actually bad advice. Right. So what we should actually do is to spend below our means and not within our means. So a simple way to do that is actually to pay ourselves first every single month. That means we automate our savings and investments before we even start spending. So this way we control our spending. And one of the worst things that one can purchase in Singapore is a car, because public transport is so convenient and cars are just so expensive in Singapore. So you only purchase a car if it helps you to make more money. If it doesn't help you to make more money, don't buy it.
So the next question will be, what are the important rules for successful investors?
Okay, David, it has been said many times. Rule number 1, don't lose money. And rule number 2, don't forget rule number 1. So in investments, we try to minimize our losses.
That's a very good rule. I would think that if you lose 50% on your original investment, you will need 100% return to gain back your original investment. At the same time, Edmond, I do agree that a very important rule is losing less is far more important than gaining more.
So David, on to the next question. When can one start to invest?
I would think that as soon as you can open an investment account. For me, I opened my account at the age of 20, but I think the statutory age should be like 18. At the same time, I think to be a successful investor, I think we got to start small, invest early, and learn from the small experiences we have. So you need to recognize your mental capacity to handle downturns and how the market actually works. At the same time, I think we should all read extensively and test if the theories actually resonate with us. And remember that investing is actually a very long journey, even for seasoned investors. It's the accumulated experiences that we had that make us a better investor.
So for some people who don't like to actually do homework when it comes to investing, what we should do is actually to tap on the experience of experienced fund managers and also our financial advisors. So if you want to enjoy the shade of a tree today, you should have planted the tree 20 years ago. So therefore, if you want to get to $1 million sooner, you should start investing as early as possible, like what David said, 18 years old. So the best time to have invested was 20 years ago, and the next best time is now.
So the next question will be, is it a good idea for beginners to start investing in alternative investment?
So alternative investments, if you're a beginner investor, I actually don't recommend you to get into alternative investments. The reason is because these might be risky instruments which are not so transparent when it comes to their financials and also the product features. So for alternative investments, if you actually get lucky and you earn quite a lot of money at the start, you may think that you will continue to get lucky and you tend to invest more and more. And then eventually, you might lose big. And on the flip side, if you have lost money in these early investments, it might totally let you lose confidence in investing altogether. And then you stop investing. So that is actually even worse.
Yep, Edmond, I totally agree. I think it's better to have skin in the game by having some exposure in the traditional investment, like funds, ETF, stocks and bonds, to kind of like gain some exposure and experience in that traditional investments. Then from then on, you can have better understanding of how the whole market works before you start to venture into other alternative investment. Then, as your experience grows and your portfolio grows, alternative investment can provide better diversification because it has lower correlation with other asset classes. This also means that all assets will not go down at the same time. Asset allocation is the most important decision that an investor can make. It drives the primary return over the long term.
Yes, David, I agree. Definitely alternative investment is a good part to diversify our portfolio. That is good for experienced investors, but not for beginner investors. And David, on to our last question. Is it a good idea to invest our CPF and SRS?
I think for CPF, once you have settled your retirement needs and your housing needs, and you have additional excess CPF, probably you can invest in a globally diversified fund. So as for SRS, we need to know that SRS, we can't really take it out for the next 30 over years. So I think it's important that we invest our SRS. we can make use of SRS to reduce our tax and at the same time create a tax-deferred retirement pot from your SRS by investing in a globally diversified fund.
Yes, David, I agree. We should definitely invest our CPF and SRS into high-quality equities or a portfolio of globally diversified funds to minimize volatility and losses. We should actively top up our CPF and SRS to the maximum voluntary contribution rates so that we can reduce our income taxes. After we have done that, we should invest these funds into a globally diversified portfolio and eventually we will become a millionaire. Thank you for tuning into this episode of Finance Autocomplete and we'll see you the next time. Bye.
Bye.